This presentation is an overview of how income taxes and national insurance contributions are calculated for workers who are in PAYE employment. It was recorded during the summer of 2023 using the 2023 to 24 tax rules as an illustration. Now, many BEC2 members are self-employed, but to understand your own tax situation, it's firstly important to understand how much people who work as PAYE employees generally pay in direct taxes, such as income tax and national insurance. It's a very general talk. Anyone can probably find a few exceptions that apply to them, and I'll be skipping over some minor complications to avoid making what is a complex question even more confusing. It's based on tax rules that apply in England, Wales and Northern Ireland for reasons I'll explain in the second talk. Scotland has slightly different set of tax bands and rates, but the big picture is broadly the same. So let's start at the question of how much tax we are all paying. And this is a graph that was published earlier this year by the Office for Budget Responsibility, which is a government body. The left-hand side of the graph shows the 62 years from 1948 to 2010. And the right-hand side, the one with a blue background, shows the years since 2010 magnified. You'll see that from about 1950 onwards, taxes went as low as 28% and as high as 35%. But current projections have it nudging 38%, and that is very high. It shows the British people paying a higher proportion of their income in taxes today than at any time since the end of World War II. And this is likely to go up even further. We're also in the middle of a period of very high inflation. From a trade union point of view, this means a lot of the gains that we normally fight for in terms of pay increases are not only being eaten up by inflation, but they're also being lost to higher taxes. So this is a really hot topic at the moment. And tax is a very political issue. Because of this, there's always lots of smoke and mirrors in the way that tax is taken from us. We could all possibly design a tax system that's a lot simpler and a lot fairer. But as Jean-Baptiste Colbert would have told you over 350 years ago, that would never work. Most people would not be able to tell you how much they pay in taxes. And they wouldn't know how much someone who's richer or poorer than them is paying either. Now, there are two big political arguments at play here. On the one hand, most people think it's only fair that those who earn more should pay more. On the other hand, most people recognise that if taxes were too high, the incentives to create wealth disappear. And when that happens, there's less tax to collect in the first place. So most people pay two big direct taxation deductions from their pay packets. The first is their income tax, which feeds the general pot of money that the government dips into to run the country. The second is national insurance. In theory, this is a contribution that we all have to make, and in some cases, if we haven't been making it, we don't even qualify for some welfare benefits, such as state pension or maternity allowance. But is the government's national insurance funds completely separate from the wider government pot of money? No. Do the government sometimes top it up? Yes. And this is a very popular misconception here, does it pay for the NHS? No, it doesn't. Now, you'll see that I've underlined the word contributions quite a lot in the slides that are to follow. This is because I'm going to be talking about the taxes that are taken directly out of pay packets, as opposed to all of the other taxes that you pay. But remember, we all also pay VAT, and I'll come back to that in a minute. We also usually pay council tax in one way or another, either directly to the council or indirectly as part of rent that you might pay to a landlord. And then there are student loan repayments. And then there are the various welfare benefits that we receive from time to time. In 2022 and 23, most households received £400 to go towards energy bills. Student loan repayments are just that, they're repayments of money that was received earlier. And then there are even some political arguments about whether the BBC licence fee is a tax or not. But all in all, it's a very messy picture. So taxation sometimes involves a bit of obfuscation. People would probably react differently to a single itemised bill that everyone had to pay in 52 weekly instalments. So the headline figures of tax that we pay, the ones that are deducted from our salary, and the ones that we all think about at election times, they're usually what we call progressive taxes. The more wealthy you are, the more you're expected to pay. And this is a graph showing income tax and national insurance only, what we call direct taxation. This graph shows how progressive taxation works, where the people who earn more pay more, and a higher percentage of their income is paid in direct taxes. Here's another way of looking at it. Purely in terms of percentages, someone who earns £10,000 a year pays 0% of their earnings in direct taxation. For people earning less than £50,000, the percentage is still fairly low. You'll see that once you're over £50,000, the growth in taxes speeds up a bit. And at £125,000, it starts to level off. It grows more slowly after that. But this fairly simple picture starts to get a bit more messy when we bring VAT and other direct taxes into the equation. So with direct taxes, we've seen that low earners pay very little or no tax and national insurance. Now here's another graph. It shows the percentage of disposable income that's spent on indirect taxes by households in different wealth bands. VAT is an indirect tax, something that you pay every time you go out shopping. But everyone pays some VAT, along with other direct taxes, such as alcohol duty, vehicle duty, landfill tax, etc. Roughly half of the things that we buy have a VAT bill added to them at a rate of 20%. And as this graph shows, it's the bottom 1/5 of the households in the UK by income that pay nearly a quarter of their disposable income. That's money that goes out on top of the progressive tax framework that we saw in the last few graphs. And then there's another thing that most people just don't know about. It's not that it's a secret, but tax is complicated, and most people really don't want to know about it. Employers also pay something called Class 1 secondary national insurance contributions at a rate of 13.8% for everyone who earns over £9,100. And that's that green bar at the top of each bar there. It may look small, but if you earn over £50,000, your employer will be paying almost £4,000 on top. At £100,000, it's nearer to £8,000. And unlike the other taxes we've looked at, it keeps going up at the same rate, no matter how much you earn. I won't go into employers' national insurance contributions in any more detail than that, but I'll just say one thing. They look like a small thing on this graph, but they're actually quite a big deal if you're a high earner. If high earners go self-employed, very large amounts of tax are avoided. HMRC are concerned about tax avoidance, where people present themselves as self-employed when most of the aspects of their relationship between the employers and themselves are the same as an employee. And the IR35 framework is designed to stop companies that hire you from doing that. You can see why they wanted to do the recent IR35 reforms. Doing so has brought billions of pounds into the Treasury. When the impact of IR35 was clear by January 2023, we saw that self-assessed income tax receipts were up by 18.4% on the same time the previous year, raking in £21.9 billion for the Treasury, and PAYE revenues were also up by nearly 11%. That money really dug the British government out of a hole at the time, because at that time there was almost no other good news on the horizon. IR35 is the single biggest tax issue that has been raised with the union by BEC2 members, and it's important that the self-employed understand why the government is doing this, whether we like it or not. However, we're still not finished. If everything that we've discussed so far wasn't complicated enough, we also have to remember student loans. If you have an outstanding student loan, you'll also be paying, and it'll be a deduction from your payslip. There are lots of other variations here depending on when you started, but for students starting now, they would be expected to pay 9% of their earnings over £25,000 a year. Most of the research I've seen tells me that most people who are paying student loans back don't know how much they're paying in the first place. or when they're going to have finished paying it. So it all adds up. You're paying income tax, national insurance, VAT, council tax, money on petrol, on cigarettes, on alcohol. You're paying student loan repayments, and then your employer is also paying national insurance contributions. So it helps to understand what tax is, if you understand that it's a bit of a game that's played between the government and taxpayers. It's designed to get the most feathers without too much hissing. Without the smoke and mirrors, it's quite possible that a lot of voters would be a lot less happy about the taxes that they pay. So far, this has all been about the standard employee picture. But what about the different sorts of self-employed and self-assessed taxes? Before we answer this, we needed to know two things. The first one is what we've covered in this talk. Why is tax so complicated? The second question, the subject of the next talk, is exactly how conventional employees pay their taxes. Once you know that, you will then be ready to understand how the self-employed do it differently. And that's why there are 3 tax talks in this series. For the self-employed, the third talk tells you what you need to know. But you may not understand any of that as well if you haven't watched the first 2 talks. Thank you for listening.